Investment policy statements. How to write one that is suitable to your financial goals. As you embark on your journey to financial independence, one of the key tools you should have in your strategic arsenal is something called investment policy statements. Writing a clear statement is, perhaps, one of the most important things you will do as you seek ways to live comfortably, retire with peace of mind, and, if needed, pass on wealth to your loved ones in a methodical way. Welcome back, folks, to another edition of Sweetie Kiwi. How are you doing today? I hope you are doing fantastic. I'm doing marvelous. If you are doing as great as I am, go grab a cup of coffee or tea or vodka and let's roll. Today I want to talk to you about how to write an impeccable investment policy statement, one that suits your financial goals. Number one, talk to your financial advisor or banker. One of the first things you will do is sit down with the representative of the firm overseeing your assets and talk to them. Learn if they have any internal guides to their suggested investment decision process. In some cases, this representative may make transactions on your account for you, and in other cases, they may act as a custodian of your account. So you want to take out a piece of paper, grab a pen, and be very, very conscious of what you're getting yourself into. You want to get ready to jot down a few notes as they walk you through their process. Be sure to ask questions on any terms or concepts you may not understand. Think about these things over the coming days and weeks, then put aside time to actually complete the final investment policy statement. Revisit your investment policy quarterly, semi-annually, annually, or biannually to ensure you are still on track. So by making decisions when you are calm and the world is in order, you won't be as tempted to stray when there is blood running in the streets and television reporters are breathlessly talking about the Dow Jones or how the S&P has collapsed, this kind of stuff, right? So you are actually making a plan for the future. I'm talking here 20 years, 30 years, so that if anything happens, if you have the temporary ups and downs of the market, you don't really care about this. Those are part of they're part of financial markets. The ups and downs are part of financial markets. The key thing is you have to be clear about where you're going, how you're going to get there, and the risk management program you're going to follow. So talk to your financial advisor, talk to your banker. This person can also be a wealth manager, an asset manager, whoever works at the financial institution where you have your assets. You want to have a meeting with that person. So once you talk to the financial advisor and have asked all the questions that are critical to you and have received the appropriate answers, set your objectives and risk levels. That's number two. What precisely do you want your money to do for you? Why are you investing in the first place? You need to assign your wealth a job. So you want to begin by sitting down and being honest with yourself about your goals. Think about how much risk you want to take on your investments. Remember, speculative investments have higher returns, but you are at risk of losing your invested funds, right? For example, your plan might say, I want a portfolio that generates dividends, interest, and rents of $5,000 pre-tax per month by the time I'm 62 years old, so I can combine it with my Social Security income and live a comfortable life. Or you might say, I want to leave at least $100,000 as an inheritance to each of my children and grandchildren, possibly in a trust fund that distributed to them as a group in equal installment over 3 years, so they don't spend it in one place or at one time. Another plan might be, I want to sleep well at night, even if it means growing my money a little slower than I probably should. So the emotional trade-off is worth it. So you have to really be comfortable, because based on your age, based on your financial situation, you cannot go into certain risk arenas. Let me give you an example. You got to ask yourself, am I risk averse or risk taker? If you are in your 20s and 30s, you still have a lot of years ahead of you until retirement. So you can basically go with the 80-20 split or 70-30 split, or even 90-10 split in some cases. 90-10 or 80-20 means, for example, you are putting 80% of your investments in stocks and equities in general, whereas the 20% goes to fixed income products such as bonds and U.S. interest, U.S. T-bills and T bonds. Conversely, if you are 50 years old, if you are in your 50s, or even in your mid 40s, you might want to limit the portion of equity, because equities are volatile, right? You don't want to have volatility as you're getting close to retirement. So you might want to switch the 80-20. You can still have 80-20, but it will be now 20-80. So 20% will be invested in stocks, whereas 80% will be in AAA rated, in the bonds of AAA rated companies that are very solid. I'm talking the IBM of the world, the Google, the Facebook, the Samsung of the world. All right. For the first two items, when it comes to risk management, right, you can use a financial calculator to determine the amount of money you'll need to set aside, as well as the compounding rate you will need to earn on your existing assets to hit your target. Don't worry, this is not as complicated as it sounds. In fact, if you read about the time value of money formulas, you've already done at least a couple of these calculations without even realizing it. All right, so you set your objectives in terms of the amount of money you want to have every month, whether you want to have a lump sum or you want to have some kind of a orderly distribution, right? Or you also want to think about whether you want to leave some money to your heirs. Those are things that will guide the decision-making process as you are writing your investment policy statement. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Key. We are still having a conversation today around investment policy statements, and I'm trying to walk you through the best way to write an impeccable one. Establish your asset allocation limits. That's the third one. I have already touched a little bit upon that, but I'm going to elaborate now. After considering what a good rate of return is for each of the different asset classes, you need to set up your asset allocation in a way that allows you to meet your objectives over your specified time frame. Right now, when we're talking about asset classes, let's just quickly define what we're talking about here. So an asset class can be equity. So equities, you're having stocks. You can have fixed income asset class. That's bonds, corporate bonds. Okay. US T-bills, US T-bonds. Then you can also invest in real estate. That's another asset class. And if you are a risk taker, you can go to the alternative investments, everything from arts to wine to farms to oil reserves. You can even invest with hedge funds or asset managers or private equity firms. So it's up to you to define what really works for you. Now, what we've seen in our research and what applies to the majority of the population, because when it comes to hedge funds and private equity investments, you're talking people who are ultra wealthy, the 1% of the population. So let's speak to the masses here. So when setting up an asset allocation plan that allows you to meet your objectives over your specified time frame, you might say, for example, maintaining cash and cash equivalents, right? So I will always, without exception, maintain at least 10% of my personal net worth in cash and cash equivalents. So if the worlds fall apart, if something happens, I don't have to worry about buying groceries, gas, or medicine. So this money does not have to earn a return. Sure, keeping pace with inflation is ideal, but it's not the primary concern. It is a reserve, your anchor to windward, right? 10%. You can also say maintain high quality dividend holdings. We are right now, dividend stocks has been a great investment in the last 10 years. So you hear people always buying growth dividends or dividend stocks. This is a very good opportunity. So you can say, I will always, without exception, keep at least 20% to 40% of the portfolio in high quality blue chip stocks that pay dividends, even when the stock market collapses by 50% or more. These are the giants of domestic and international commerce that make up the backbone of the global economy, right? As I said, they might seem boring. The Walmarts, the IBM, the Samsung, and they might not even appear to grow as quickly as some next big thing with stock, but they can get the job done while giving me peace of mind, because they should always be worth more 10 or 20 years from now, regardless of the interim volatility. And that's the key word here, the interim volatility, the temporary setbacks, the temporary ups and downs, the temporary down market. That's what a lot of investors, a lot of inexperienced investors are scared about. But if you invest in a solid company, chances are over time, the stock price will always go up, and they always do. The third option, you might think about it and you can say, maintain real estate or cash generation. I will keep at least 20% of my portfolio in directly owned, cash generating real estate in my hometown. It will be a backup residence if I need to move out of my house and downscale, offering an added dimension of utility. So the rental income will help me fund my other investments, and its low correlation with the stock market returns gives me a degree of safety that I otherwise would not have enjoyed. You'll have to work out the details, but arriving at the right mix for your lifestyle can help you avoid finding yourself in a poor situation, right? So you have to look at the asset classes, cash and cash equivalents, equity, fixed income, real estate, alternative investments. This is the kind of mix you have to work on. Now, if you don't have acumen in finance, it's always good to reach out to someone who does, right? You can reach out to a certified financial planner, a CFP, a certified financial advisor, a CPA, a certified public accountant, for example, or even an attorney who has experience with estate planning and wealth management. I'll be right back right after this. Don't go anywhere. Welcome back, folks, to another edition of Sweetie Kiwi. We're also having a conversation around investment policy statements. If you love the content's clarity and quality so far, please consider subscribing to our channel and turn on the notification bell so you can be informed in real time whenever we drop a new show. And we do this every single day, rain or shine. Also, if you like the content, you would like to contribute, you love everything that we've been talking about so far, please leave us a comment, leave us a question. If you have a question, we'll answer you. And also let us know in the comment section what kind of topic you would like us to cover. Let's now talk about establishing the mechanics of running the portfolio. You need to decide how often you will evaluate your portfolio to make sure you are within your predetermined limits and hitting your compounding fence post. The investment philosophy you will use to add new securities or funds to your portfolio is very important. This is the difference between people talk about conservative, buy and hold blue chips, or sell like every quarter and rebalance the portfolio, right? You can say, I will only consider stocks that have increased their dividends for at least 20 years in a row. Determine how regularly you will rebalance your holdings, or whether you will rebalance at all. Set the measurement period you will use to determine if your strategy is on track and working. Anything less than 5 years is not smart. The evidence and plenty of research has shown that stocks tend to grow over time. But of course, you might have temporary volatility. You might have temporary down markets, but overall, they're always growing. So if you're going to compare your portfolio to a benchmark monthly or even yearly prior to the 60-month threshold, you're probably going to do something wrong by selling or buying at the wrong time. Now, before we end this show, please make sure you write out, sign, and date your investment policy statements to keep yourself accountable. If you say you aren't going to allow a single stock or bond to exceed 5% of your portfolio, stick by your own guidelines. If you're going to keep a certain amount of tax-free, if you're going to keep a certain amount in tax-free municipal bonds as an emergency fund, do it. Think of it as the portfolio equivalent of a prenuptial agreement. The only thing is, the agreement here is between you and your money. It's a lot easier to make decisions calmly beforehand when it's all wine and roses. All right, folks? So this is pretty much it you need to do. You need to know how to write an investment policy statement that is suitable to your financial goals. Number 1, talk to your financial advisor or banker. 2, set your objectives and risk levels. 3, establish your asset allocation limits. 4, establish the mechanics of running the portfolio. I will talk to you another time, but until then, remember, stay marvelous.